Welcome to StockOdds post Thanksgiving podcast ready for the week ahead. Good evening, Rob. How's everything?
Definitely post Thanksgiving. Your turkey's still affecting you.
I know. I've got turkey in the brain. Tryptophan overloads. Not ready
Well,
for the week, huh?
the best is leftovers, and then also you make some turkey soup too, right? So that'll keep you going. So interesting. So we had a half day on Friday, and it was pretty much a tight, very tight range trading day. There was a bit of difference between the four markets. The strongest was the Dow 30. The weakest was the NASDAQ 100. The S&P kind of traded near the top of Wednesday's range. The Russell kind of, I don't know, towards the lower end. Same as the NASDAQ actually did break Wednesday's low a bit. So SPY had an inside day. Actually, by a penny, I think it tested it, but otherwise an inside day. It was a really interesting, quiet day. Sometimes we have big moves on, the half day on Black Friday. Just depends on, what kind of catalyst was happening. So it was quiet. And what that does is it kind of puts a little monkey wrench into some of the list curation to some degree, because it wasn't a day where things could really shine, and I think you're dealing with a little bit more macro influence coming out of that rather than the statistics from the day itself. So it might be better to look at kind of a Wednesday 3 days or 5 days. Probably 3 days would be fine, because that would take you to Tuesday. Then you're not dealing with the last trading day of the month. So it's almost like you need to kind of compare notes between your 3-day from Wednesday and your open to close for Monday that comes from Friday. Do you follow what I'm saying?
Yes.
Dave? Right. It's just because we had a very, very small range, non-event type of day. So and lighter volume, like nothing really happened to sort of create a good statistical framework. So I'm thinking, take Wednesday for a 3-day output and compare that to what you get. And it's easy to do. Just take all your outputs that you would do normally from Friday, and then take those same symbols, pop them into Wednesday, and just do a 3-day output and run through, a few of the signals or indicators and see what you get. Right. See if there's any arguments that way. That would be the quickest way to do it. Anyway, just letting you know. There are some concerns here for the day and a few days ahead because of this China thing, right? So, as you know, China has the zero COVID policy. Now we're getting massive protests, and China's stock market has already started to respond to that. They had 4 days in a row of the record cases of COVID. And this is in spite of all the lockdowns and all the preventative measures that have happened. I mean, it's just crazy how many cases, in light of that type of environment. So people are getting sick and tired of that. I noticed something interesting too, that you saw the news that Apple restricted the AirDrop file sharing that protesters have used. So here's Apple turning off their AirDrop feature. That's kind of weird. It's kind of weird. I mean, but anyway, it is what it is. So, that I wouldn't go and buy, Chinese listed stocks on a New York market or NASDAQ. in light of the weaknesses there. It's probably just avoid China if you can. Okay. I think that's a better approach. So we had Black Friday sales. So online there was a record in sales, but in store very, very low turnout. So there's a difference here between who is selling online and the brick and mortar. So keep that in mind for Monday. Now we do have typically Cyber Monday, but I mean all the days of pre-Black Friday, because sales already started earlier in the week. Black Friday itself and even Cyber Monday, most of the business is being done online anyway. So again, brick and mortar suffering the most. What else we got? We did have kind of overall, still even with the online record sales, I mean, it's still coming out globally that pretty lackluster, like, for example, Australia retail sales fall for the first time. So this, this interest rate, inflation, all of this is harming the consumer. I don't think there's a question there. And also, you might think that with potential for rates to subside, because that was one of the arguments that was coming out and what we saw from the minutes, is that there's more people within the FOMC that are supporting maybe a more lenient path going forward. So at some point, rates have to start to subside in terms of the hikes. If that's the case, then we're thinking, well, that could possibly mean the consumer does come back a bit. But if they're thinking that, maybe they wait and see if prices will come down, because I can imagine that there could be an inventory problem because the consumer, has backed off already up to this point. And maybe in order to compensate for the lack of supplies, they ramped up their orders and they end up now with a lot to sell, but maybe not the demand. Could you see that happening? So that could be deflationary, right?
Yeah. Actually, on the ground, I went with my wife to some stores, the mall, Target, and Costco. And we've never seen this light around Thanksgiving. There's always like crowds of people and lines, and it was just like a normal day during the week. It was very odd. We've never seen it this light. This is in California, but it was kind of peculiar. And I listened to conversations too, mothers telling children, "Wow, this used to be the dollar section. Now it's $4." You hear that banter back and forth in the store, what people are feeling, and this used to be this price and that price. So they're feeling it. I mean, so there's a
and
big
then
effect
they opt out, and then they could actually have a hope that things do normalize at some point, which isn't unexpected. I mean, it's no different than I was telling on the show the other day. My wife had picked up a head of cauliflower and got to the checkout line with a few other things, but put it through, and the head of cauliflower was $15. And she's like, "What?" Like, no, thank you. And then the cashier says, "Yeah, that's what everybody's saying." So it's like, we can do without, right? It's like, even if you had the money for it, it's sort of the principle of it. And I think that's where a lot of, because, people may have the spendable cash, but they just can't come to grips with, what the prices are. And so it's almost like offensive. And well, I don't need that as much as I thought I did. So they'll change their habits for sure. So, and this is what, we've been in this for a while now. I mean, we started yakking about inflation back in August and September of last year. So it's been over a year now of prices, starting to climb. And And I don't know if we're done, but if the consumer is looking down the road to say, well, you know, this is going to have an end to it, so I'm just going to hold off. I mean, no different than if you thought that your TV that you wanted to buy was going to be, 50% less next year, like maybe you can hold off and just wait it out and buy it next year. I mean, that's the same thing. And that's why deflation actually can be bad for spending habits, where generally inflation initially in the inflationary cycle, people scramble to get things because they're going up in price. So that's what happens initially when inflation starts to just, jump out at you. You kind of scramble to lock in things. And then once it's well underway and it's been there for a period of time, that's when it really starts to hurt the consumer and they start backing off. And then that could become ultimately deflationary. And then deflation is not necessarily the best thing for people's spending habits either, because if something's going to be cheaper in a month or 3 months or a year, they're going to hold off, right? No different than they wait for Black Friday sales. They didn't buy 2 weeks ago because they were waiting for a Black Friday sale, right? And overall, the online sales were fairly robust. It says they were a record, but in general, I think when you add it all together, it was a fairly lackluster Black Friday, and that's what you saw too. So,
and I think the products really
Mhm.
had incremental improvements, like an iPhone 12. I mean, iPhone 14 versus an iPhone 12. Do you really need to jump up to that next one? Or the television that was a certain resolution last year, it's slightly better now. I think people are so flush with goods now from the pandemic in the last couple of years that they're not choosing not to bump up to that next slightly
Yeah,
better.
you don't really need it. No, it's true. And well, Apple has also got this problem with China, and with its manufacturing and the protests that have been happening there too, with Foxconn. And Apple was one of the technology stocks on Friday that actually sold off the most. Did you see how much it was down there? It was down almost 2%. And I mean, Google was only down 1%, Nvidia down 1.5%, Texan down 1%, Amazon down 0.77%, AMD was down 1.65%. So Apple was down, 1.96%, almost 2%. And it's been holding up, for a while, a little better than some of the other tech stocks. So it's interesting. So a bit under pressure, and part of that could be this upgrade cycle. Like, do we really need it? And now they've got the problems with China, and you know. Anyway, moving on. We saw a headline that 487 million WhatsApp phone numbers for sale on the dark web. So WhatsApp never has been one of the more secure apps out there. There's Signal and Telegram that people say are much more secure. But anyway, 487 million WhatsApp phone numbers for sale. There you go. Meta might be affected by that again, since they own WhatsApp. What else? Venezuela oil. Now, this has always been a head scratcher for me. It's like, so some of the sanctions kind of eased up a little bit so Chevron can start doing their thing in Venezuela again. But I remember back a few years where, with Venezuela having such an issue, Russia went in there and really made some major deals. So isn't it like, if you're getting oil from Venezuela, you're kind of supporting Russia to some degree? I don't know. It's just a head scratcher to me. But what do I know? Anyway, over to you, Dave. More
We have some.
exciting news.
Yeah, so I was focused on the almanac. Again, we're end of the month here. The last day of the month is expected to be a little bit soft, but I wanted to look ahead to the first day of December and the first Friday of December, which are coming up. In the month of December, the SPDR is expected to do minus 0.27%, and the NASDAQ about the same, but the IWM, the Russell, and the Dow are expected to be positive, 0.25%, 0.17%. So it's that kind of month. But for the first day of December, the kind of sectors that are expected to do better are gold and silver, GDXJ 1.6%, silver 1.18%. Those are the two best ones. And also oil, XLE, XOP, and financials, XLF. Things are expected to be shorter or weaker. Brazil, the EWZ, minus 0.7%. And KWEB, KWEB, that's the China ETF. That's expected to be weak. So here we are coming in with this macro news on China, plus seasonality-wise, it's expected to be weak coming into the first day or two of December. So again, like you were talking earlier, you might not want to get long some of the China stocks. Other things to be shorter on the first day of December, the chips, SMH, ARC, KK, XBI. So a lot of the risk on stocks a little bit softer. And then on the first Friday of December, again, the KWEB, the China ETF, is expected to be weaker, where things like oil, gold, some of the financials are a little bit stronger. So there are some plays there, but the theme here of weakness in China, weakness in and strength in gold and silver seem to be a predominant theme there. And then also in terms of economic reports and earnings, the main ones this week are really going to happen on Tuesday. They're home prices, home price index, consumer confidence on Tuesday. And on Wednesday, we get an ADP employment report. Also some reports on job openings, so that can give some clarity as to if all the interest rates increases have affected employment. On Thursday, again, initial jobless claims and the PCE core price index, so some inflation data there, ISM manufacturing. And on Friday, we have our first Friday of the month. We get our unemployment rate and non-farm payrolls. So that can drive the market as well. So if we see a little bit of softening in payroll and the unemployment rate, that could also hint that the Fed might be a little bit more lenient come the next few meetings. But if the employment numbers are really, really strong, they could remain being hawkish. And then on terms of some stocks that have earnings this week, we have on Tuesday things like CrowdStrike, Intuit, Workday. On Wednesday, Okta, so some of the NASDAQ more growthier stuff, and Ulta on Thursday. Yeah, so Friday. So it's just still a smattering of earnings coming out, but the big driver could really be unemployment and the jobs numbers. That's all I have on this side here.
Okay. Yeah, I mean this last day of the month, beginning of the new month, turn of the month effect. Just watch out for that, just because we got a lot of things in play here, and we're coming after sort of the holiday, and a lot of people made like a extra long weekend out of it as well. So could be interesting. And then December, we have seen some corrections in December. If we go back 4 years to 2018, you remember that big dip we had right in December. It is possible with all of the forces that we're seeing that we should anticipate that could happen again. It was 4 years ago we had a significant correction in December, so I wouldn't be surprised if it happened again. People are always asking, what about Santa Claus rally and this and that? But, there's the pre-rally before Christmas that's possible, but there's also between Christmas and New Year's. And so you could look at either of those as the Santa Claus rally potentially too. Doesn't mean it's pigeonholed to a particular 5-day period in the calendar. It could be before Christmas or after Christmas. But anyway, it's an interesting time. Normally, the breadth of the market is really good in November and December, some of the best of the year historically, and that means broad market rallies typically have happened. But we're seeing this divergence now between, like this week was kind of defensive. I mean, you look at the utilities; they were up 5% for the week, 5.01%. It came out that the week ended with really the consumer staples and the defensive stocks like utilities, real estate did okay. Financials weren't too bad in light of the fact that the interest rates aren't rising anymore. Usually that benefits the financials. So it was an interesting week, but it was leaning more to the defensive side. And yet we called it, remember, Dave, we called it a bit of a risk-on week, right? So we were expecting it to move higher. And I think, what was really eating into this was, some of the China thing that's been going on for a few days already. And this lackluster consumer had been already kind of nipping at this. So anyway, I am definitely prepared for down session. Now the next 2 days are supposed to be positive historically, and then the last day, Wednesday, down. But you could already have the market just on the back of this holiday here, just turning over and heading down. So you have to allow for that. If I run over to the futures right now and just take a peek here, let's see, we've got. So since we opened at 6 p.m. Eastern time, we pretty much slid down, kind of stabilized now. But the Dow Jones, which has been the strongest of the markets recently, down 165 points or 0.48%. S&P down 2550 or 0.63%. NASDAQ is down 89.75 or 0.76%. And the Russell's down 13 or 0.70%. Now, remind that typically, if we have a down open tomorrow morning, that a lot of the time with down opens, the small caps hold up a little better because you get to buy them at a discount plus their beta or volatility impact. So they actually move down a little bit more than the IWM. Like the IWM might be opening down, 0.71%, but the stocks themselves could all be opening down 1.5%. And that's why that relationship between buying them and then even hedging or beta hedging can be so valuable with the small caps. But do take a look at your sectors and think about what's going on here, because the China slowdown with all the protests and the lockdown, all that infers that oil will continue to be softer. And that being said, some of the oil stocks have been doing amazing in spite of oil prices declining, and other oil stocks have been falling along with the oil price. So it's a very mixed bag there. So just take a look at what's in the Russell list and think about that impact, because a down open can be good, but sectors behave differently too. So typically, if tomorrow is a risk-off environment, let's say we come in and things are still soft and everything looks like risk-off, meaning that you want to be more defensive, then you still favor consumer staples, even though they've been in the lead for a long time. If the dollar is pulling back a bit, you might favor basic materials. If the financials, if TLT and bonds and interest rates are okay, you might be okay with financials and real estate. The thing that would probably be softer would be the technology and consumer discretionary, especially on the back of the Black Friday stuff. But again, separate your online from your brick and mortar. I could see doing a basket where you're short some brick and mortar and you're actually long Amazon. You know what I mean? That's it's possible to look at things that way too. Utilities could be stronger. Industrials are kind of, they were stronger on Friday than tech, obviously. And communications, especially with the WhatsApp thing on Meta, I would say it'd be softer. So it doesn't take that much effort to sort of create yourself a risk on list versus a risk off list. It doesn't take that much more work. It's about using your statistics to take a look at the big picture, but then it's how you sort things, right? It's how you sort them. What groups do you concentrate on? Where's your weighting? Like, for example, obviously it would be wrong to be 100 in a risk off day where things are probably going to decline. It would be wrong to be in 10 consumer discretionary stocks. I mean, that's kind of obvious, right? So then,
Yeah.
what's that inferring? That there's a better way to diversify, there's a better way to balance, there's a better way to be exposed, and the groups do matter. You could probably be in 10 industrials and survive, but 10 discretionary, you might not. So it does matter. You push yourself back from your desk and look at the big picture. It does matter. All right. Well, hopefully that's been a help, and we'll let you go. Have a good night.